Yeah, so today we're going to do start the chapter 11, accounts receivable. And then we'll go on to monetary unit sampling. And monetary unit sampling is another way to do sampling that we'll find, and it's, down here we have planning the audit. And we also have to gather evidence of the audit. So this is part of the gathering evidence to see if something is materially misstated, just like we did for classical sampling. Okay. So without further ado, okay. All right, so accounts receivable is another very important auditing account, and there's a good reason why. If you sell something for cash, you get cash and you put the sales or revenue or both on the books for the same amount, and you have this cash that came in. Now, cash, you can, if they paid cash, you can trace it to the bank, right? Bank deposits, the list of checks. We'll go to the bank. If there's any cash coming in, it'll be counted on the cash register. That'll be going. So this cash, when it comes in, there should be several listings of that cash coming in, and it should show up on the bank statement. Okay, so how do accounts receivable come about? Accounts receivable come about when something is bought on credit. And when something's caught on credit, we have this journal entry: accounts receivable and sales revenue. Okay, why is a sale on credit more susceptible to fraud than a cash sale? The sale will be the same. The sale, whatever. I should probably not change that. Why is a sale on credit more susceptible to fraud?
So I would say there's like a timing or delay receiving the cash for the sale.
Yeah, exactly. There's a delay in the time you get the sale. So here's why it's very tempting to somebody who wants to cook the books or to maybe make themselves look a little more profitable, is to have a sale. Now the cash isn't coming in, so what they do is they set up possibly a fictitious company, or possibly even they ship it something that someone didn't order. But then they put this accounts receivable on the books, and that accounts receivable, most of the data for that sale is going to come from the client. They'll have the sales order and the sales invoice and all that kind of stuff. So accounts receivable is much more susceptible than cash, and it's a way that someone can make a sale, even though a fictitious sale, much easier than cash. If they put it on for cash and there's no cash coming in, it's going to come out in the bank reconciliation, and the statement of cash flows isn't going to balance. It's going to be caught fairly quickly. But accounts receivable is different, and that's why it's riskier. And recently there's been a spat of frauds that are done on accounts receivable. All right. So, and actually what you said, there's a delay in the cash. Possible fraud due to fictitious sales. Again, a lot of times you may not know that it's a fraud until later on. And a lot of times when people commit frauds like this, did I show you guys the Anthony tape or video? I know I showed it in other classes, but I'll do that. I'll do that sometime here. But anyway, one of the possible things is that there would be a delay, and it's often that people say, well, you know what, we'll fix it next year. Next year the sales are going to go up because we have this coming out, blah 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 blah, and then that doesn't happen, and then it keeps going on and on. But anyway, okay, so hey, documents and controls over accounts receivable and the revenue cycle. So accounts receivable and revenue, these go hand in hand. These two, how do you get accounts receivable? You get it from, selling something. That's how these accounts receivable come in. So revenues and accounts receivable are locked together. Okay, customer purchase order. And this purchase order is a third-party document. So it's going to be a little bit better evidence than something coming from the client, but it isn't always used in sales, obviously. Like when you go to the store, you don't buy milk and say, oh, here's the purchase order for that milk, because you bring up the register and they run through it. So purchase orders are not always from the customer, are not always used. Sales order. All right, sales item is completed by the sales store with a present quantity. Now this is client generated. This is a client generated document. Yeah, just by saying created. So notice there's no purchase order and there's a sales order. They could make a fake sales order. Credit approval for customers. Be made by the credit department, if they have one. If they don't, credit approval, should never be made by every highlight. Hopefully they have a credit department. If they don't have a credit department, you say, okay, well, who does the credit approvals? Maybe it's not that big of a place. It should never be done by the sales department and our accounts receivable. These have authorizations, these have record keeping duties. So credit approval should never be made by those two. Okay, pick list and or packing list. A list for operational plays to complete in order. Or, let me try that again. Order. Everything. The pick list should be on the sales order. Now, that doesn't mean that everything will be shipped at once. There might be things that are out of stock and all that kind of stuff. Okay, sales invoice. Sales invoice should match. Okay, which one should it match? Should it match the sales order? Or should it match the pick list? Or packing list? Which one should the sales invoice match?
Sales order.
Actually, it's gonna be the packing list because there might be things that are out of stock. You know, first, let's say they ordered 10 things, we only have 8, well, we'll send 8. So what's on the packing list will be what should match the pick list or packing list.
Okay, thank you.
Actually, though, what you just said isn't that bad because I've seen textbooks that will say it should match the sales order. The sales order should be sent out complete, but that's not usually how it works.
Yeah, I mean, in the real world, like they do their best to match for the sales order. If there's no like purchase order, but yeah, I mean, back end list makes sense.
Right, and sometimes they can substitute things like that, and sometimes it's allowed depending on what it is. Okay, collection of receivables. Obviously, this is. Oops. Collection of receivables. The collection of receivables is the best evidence of valid receivables and valid sales. If somebody actually pays for it. Okay. Now, we're going to come up to 2 of the most important documents on here. Now, of all these documents, all of these are going to be client created. Well, except for the purchase order, the first one.
Professor, can you go back to collection of receivables?
Absolutely. Yeah, collection of receivables is the best evidence of valid receivables. In other words, if somebody pays for it, it's hard to argue that it didn't exist. Okay, now client created documents are generally not as persuasive as third party. So you notice everything we have up here, and this is one of the reasons why it's tempting if you're going to try to cook the books to do it through accounts receivable. An awful lot of the documentation is created by the client. Sales order, credit approval, the pick list, sales invoice, those are all client created. All right, so it's good to have the shipping document. Why are these labeled as shipping documents? Let's correct that. Now, shipping documents. These are generally between the client and the third party. In other words, the shipper. And there's two main ones that we look at. All right, the bill of lading. Bill of lading has been around for a million years. Okay, maybe not that long, but a long time. You can find bills of lading, going back hundreds of years. And what a bill of lading is when someone picks up your stuff, you are transferring possession of the goods to the transportation firm. So you're transferring the goods. They generally have a description, number and description of what they are. Signed by both parties. So the carrier will sign off on it, saying yes, this was loaded. The shipping department will say yes, this was loaded. Seller and buyer addresses. Prices are usually not included. Now, it's transfer of possession, not of ownership. So when those goods go on that truck, they usually don't put dollar amounts. They can sometimes, but they usually don't put the dollar amounts on there. There's no reason to. You're not selling it to the shipping company, and they have no way of knowing. They're not going to. Unlike a customer, they're not going to care whether this is $10 or $20 or whatever. But you're saying, okay, these are the goods that we're loading. This is what they weigh. This is, all that kind of stuff is going on, and they both sign it, right? You're transferring possession, but not title. The shipping company does not own the goods. They never own the goods. It's a bill of lading. It just says this is in your possession. They're responsible for it, but they're not buying it. The only reason they'd pay for it is if it got stolen or burned up or whatever. But it simply is them loading goods onto the truck. Now, bill of lading is a very important document because you can actually verify it with a third party. If you get a bill of lading that you're questioning whether this was real, you can look at. They should have the name and address, whatever the shipper was, and you should be able to contact them and have them verify that they, that this is a valid bill of lading. So you can actually, even though the client will have a copy of it, you can actually verify that directly with a third party. So while it is that it's with a client, get out of here. Give me these Zoom. They have so many pop-ups now. It's crazy. While the client will have it, you can also verify it with this third party. Let's write that in. So bill of lading may be verified with the shipper, third party. Okay, there's also a proof of delivery, and the proof of delivery will have the date of delivery and signed by the recipient. This could also, again, I know everyone's used to now seeing like Amazon and whatever, they take a picture of it. You know. I had a funny one. They took a picture of it, and I realized that the picture they dropped it off at somebody else's house, and then I realized like which house it was. So you know, it was like down the street a couple. Like, wait, where did they deliver it to? Oh, I know that. But anyway, so proof of delivery. Now, proof of delivery you would think would be the better of the evidence, but actually, bill of lading shows that the client made the effort to make this, that this was a real sale. So even if it got lost in transit somewhere, you know, the proof of the bill of lading is really proof. This is usually the best. It shows the, it shows that the client actually made a sale. It may not have, you know, may got lost in shipping or burned up or whatever, but this is very good proof that they actually attempted to make the sale. So even though the proof of delivery you think might be a little bit better, for us, we're really looking to see that they made the effort, that it was actually loaded. It was loaded onto the truck. It was, you know, shipped out. And if it didn't show up, sometimes they don't show up. It was still that sale was still a what we call a valid sale. It may not have shown up or whatever, but you know, that's for insurance and whatever to figure out. But so this bill of lading is really the most important one. So whenever you wonder if something was actually sold, you look for the bill of lading.
So Professor, I have a question here.
Yeah.
So that applies to like selling merchandise. How about like providing service? Which one would be more suitable here?
Well, yeah. I mean, if it's a service, when it's completed, when the service is completed, it should be signed by, you know, the contract or whatever should be signed by whoever the customer is, and you should be able to look up that customer and verify that that was actually done. So
Okay.
yeah, and especially if you know, if the payment was made later, you know, okay, they sign off on it, but they haven't paid it yet. So you have to be careful about, you know, another thing about like things like services is that you could have someone sign off on it, you know, someone hands it to their whatever and says sign this, and sign this as you know, whoever, that it's a fictitious contract. Yeah, so anyway, yeah, they should have people sign off on it, but those contracts should also be able to be verified, and that customer is still a third party. Yep.
Thank you.
That's good. That's a really good question. There's actually been quite a few frauds that were done with those kinds of things. There's a famous one. I think this guy's back in jail now, and he came out and was like, I'm reformed, and then he did one more fraud, which is very common. But anyway, it was ZZZZ Best, 4 Z's Best, and it was this young guy, like 18, 19, whatever, started this company of rehabbing these like buildings and houses and all this kind of stuff. And it grew, I mean, he was like, it was trading on the stock exchange. Before Enron, this was like the biggest fraud there was. He just started making up all this fictitious stuff. And, you know, he was using kiting and all kinds of stuff to make it look like they had all this money coming in. But one of the little bit humorous things about it was he had these multi-million-dollar contracts that were signed off, and they were all on one page. You know, usually if you're doing, you know, if you're doing a rehab, you know, $4 million, you're going to have all this, you know, lighting and electrical and plumbing and all that, you know, it's going to be really broken down. And you would just have this page that says, we'll pay you, you know, $4 million. signed off on it, and the auditor took it. You know, it was a very odd kind of a fraud, but yeah. Okay, aging of a trial balance. So something you probably did in your first accounting, maybe your second accounting class. Aging of trial balance. Oops. This is terrible writing. So, the long period of time that accounts receivable is not collected, the less likely that it will be collected. And so they do what they do at aging of accounts receivable, and you guys, like I say, you guys have, I'm sure, done this, and that's like, you know, if the account is if the account is current, you know, oops, maybe 2% chance that it's going to go bad. Oops. Hey, what am I doing? If it is 1 to 30 past due, then there's a 10% chance. If it's 31 to 90, you get the idea. Maybe there's a 40% chance that it's not going to get paid. You know, as time goes on, it becomes less and less likely it's going to be paid. And so that's what an aging is. You know, you'll break up the accounts receivable. Okay, how many accounts receivables are current? Okay, 2% of those will go bad. How many are 1 to 30 days past due? Okay, 10%, and so on. The longer time you get out, the less it's going to be. I've done audits where they've accounts receivable on the books for 6 years. It's like, you're never going to collect it. Okay. Industry average of bad debt expense. Compare the client's estimate with the industry average. So there's places that will do the industry average that you can actually look up and see what it is for different industries. Now, yeah, go ahead.
Yeah, sorry, like multiple question. So why like some companies they don't like to show like a bad debt expense on their like books? Is there like a reason?
Well, they don't put it in the financial statements usually. Usually they just show the financial statements as being net. It needs to be in the notes somewhere. You know what it is if there is a bad debt expense. Yeah, and you're right in that a lot of times they don't actually break it out and show it, and it'll be buried in the operating expenses somewhere usually, the bad debt expense. But yeah, they're supposed to be. They usually do publish it. Now, we haven't talked about this yet, but this is what they call an analytical procedure, and it's a weird one that it's an analytical procedure. I think it's the only one I can think of where it's actually, it can be evidence of a misstatement. Whereas if you have a client that's right in the middle of the road, you know, they're an industry average company, and that their debt is not does not conform or isn't close to what the industry average is, that can be used as evidence that that their estimate's off, whether it's too high or too low, whatever it is. But it's kind of a strange one because it is possible that a company doesn't have, it doesn't line up with the industry. That, it's possible maybe they have a really tight credit policy and they don't have very much bad debt, or they have a really loose policy and they have way more bad debt. It is possible that it doesn't match up with the industry, but yeah, so it is kind of one of those strange ones. But and we'll talk about this more later. This is one of the weird ones, that this is actually an analytical procedure, which generally you don't use as evidence, but in this case it can be used. I'm gonna put that right by this. The weird analytical procedure. I'm going to actually make it a little more of a statement on it. Let me take out. As a substantive test. Analytical procedures usually are not proof of anything bad, but in this case it can be. And I think this is the only analytical procedure that I can think of that's used as a substantive test. Most analytical procedures will tell you where to look, but they won't tell you necessarily that something is wrong. Whereas this one can actually be used to tell you something is wrong. Okay. Sales journal, reconciliation with the accounts receivable ledger. So and you can do that daily, you can do that monthly. But the credit sales should match the accounts receivable ledger entries. And one of the reasons why that's important is that, actually, I'll go back up here. This accounts receivable. Now, we just have this as a plain old accounts receivable, but truthfully, this accounts receivable should have a customer associated with it. This is accounts receivable for Joe, right? This is Joe's accounts receivable. The danger is that you don't have this one makes a journal entry in a plain old journal entry that comes out of the in the general ledger, that someone just made this journal entry without assigning it to a customer, right? Every accounts receivable needs to have a customer assigned to it. And so if there is a credit sale that does not match up with the accounts receivable ledger, that has all of the specific names of customers, right, then there could be a problem. I'm gonna put one more thing on here. usually for things that happen a lot, they use what they call special journals. For example, every sale made at Walmart, you could have an accountant make a journal entry for every single sale they make. So someone comes in and buys a Snicker bar, and the journal, an accountant makes a journal entry that a Snicker bar was sold, blah, blah, blah. That usually doesn't happen. So what they do is they have what they call special journals, and these journals will say, here's all the sales that we made. And there'll be one entry, especially nowadays, it'll be automated. It'll automatically make that entry, store 238. This is what their sales were. This is what came in cash. This is what came in credit cards, whatever it is. And that will put them all in at once. And that's the way sales should come through. If there is a special journal, they should go through there. The problem is sometimes especially if you have entries that don't go through the special journal. For instance, the sales journal. If you have a sale that doesn't go through the sales journal, that could be a problem. Why isn't it going through the sales journal? Everything on the sales journal gets put into the ledger. So if you have something that is not going through the specific journal that it's supposed to go to, it could be sales journal, it could be accounts receivable journal, it could be purchases journal, whatever it is. Those things that all have the same journal entry, and usually nowadays it's going to be electronic. They should always go through there. So let me clean up what I just said here. And these are, there's special journals for almost everything. This is one of the special journals. Yeah, there'll be one for purchases. There'll be one for, things that are repeatable, that happen all the time. They usually have special journals. And so the sales journal have a big list of everybody who bought the stuff, and then those should show up in the accounts receivable listings, and everything should go through there. If it doesn't go through the sales journal, then you are immediately questioning it. Okay. Sales cutoff. Sales that are shipped by year end are counted as sales. If they are not shipped by year end, they are not. That's the general rule. We'll talk about an exception in a second here, but I should not shipped by year end. By the way, let's go back here. What document are we probably going to be looking at to see if we count it as a sale?
Bill of lading. Yeah.
Yep. Bill lading. See, what am I doing? Yeah, the bill of lading is what you're going to look at. You're going to go look and see what the last bill of lading was, and see what. Actually, there's a problem we do later on with it. But you're going to see what the bill of lading. This is what's going to determine whether it's a sale or not. So any of these that are marked, December 31st or earlier, it's a sale. If it's marked January 1st or whatever, it's not a sale. So bill of lading is really what we look at for this. Bill and hold. These are generally no-nos. It actually is quite a bit, it has quite a bit of criteria, but basically. You want to be down to the request of the customer. There's more criteria than that. I'm not going to get into. It has to be. It can't be. You know that they're locked into it. They have to pay for it no matter what, even if it's not delivered. And there's a bunch of other stuff in there. But basically, it's not at the request of the customer. You cannot simply say, "Oh, gee, we're not going to be able to ship this stuff out. Let's just mark it as, we'll just mark this as sold and put it over here in the corner. We'll count that as being sold." You can't do that. So if it doesn't get shipped out, notice that there's two things that happen. If it doesn't get shipped out, it's not a sale, and it's still in your inventory. So if it wasn't shipped, generally speaking, unless it meets the wacky bill and hold rules, it's going to be, not only is it not a sale, but it also, the inventory is counted as inventory, so one of your assets. Okay, pledging accounts receivable. Oops. We pledge for loans. This relates to so even though they have the accounts receivable, it's possible they don't have the rights to them. Those rights are pledged to for this loan. So it is possible that those are, they don't have the rights to those accounts receivable. The custody will exist, but they don't have the rights to them. Okay, confirmations. All right. I don't think I went through the different levels of evidence. Okay. Levels of evidence. The best evidence is created by a third party and is held by a third party. Medium evidence created by a third party held by the client. Worst evidence Created by the client. Held by the client. Okay, so best evidence, third party, it's held by a third party, and it goes all the way down to the worst. Client held, so the client made it and the client's holding it. Now, going back up here, all of this stuff, the sales order, credit approval, pick list, sales invoice, this is all the worst evidence. Client created it, client holds it. All right. So, all right. So, this is where you're sitting for all that evidence there. What you want to try doing is moving it up. How do you take this evidence that you can't really rely on, and move it up the ladder? Like get it to medium or even get it to best. This is, ideally you'd want to get it up to here. The best evidence. So that's what we're going to do with these confirmations. We're going to send out confirmations to these accounts receivable and ask the people, do you really owe this amount? If you look down here, this is kind of the letter. Is the amount indicated above correct? You're asking them, does do you owe this amount as of year end? So what we're trying to do is get this worst evidence, all the client stuff, moved up to the best. And notice that we have this put on the client's letterhead. I'll get to the positive and negative ones here in a second. But we have it. I goofed up the spacing here. But we have it returned to the CPA firm. The CPA firm are the ones that actually get this back. So for instance, let's say this is IBM, we put it on IBM letterhead, because if we send this out and it doesn't say IBM, they're not going to know what we're talking about. But when it's returned directly to us, so the client doesn't get a hold of it. Okay, so we have two different types of confirmations, positive and negative. All positive confirmations must be returned regardless of any errors. Negative confirmations are only returned if. Which confirmations do you think that we're more concerned about? The ones that have errors or the ones that don't have any errors? Which ones are we more concerned about?
The ones that have errors.
Yep. Negative confirmations are only returned if there are errors. I'll show you kind of what those look like. Okay, so this is give me a different. We'll make this one green. We'll make this one. Okay, so positive accounts receivable confirmation. It'll have everything on here. You know, these are the following invoices. Generally, you want to break it out by invoices if you can. You know, as of December 31st, did you owe this amount? And if they say yes, that's fine. If they say no, then they say if it is not correct, then explain, and you'll write down here what your explanation is. And return that to the CPA firm. Now, you have to collect all of these. This is a positive one, so if you send out 100, you gotta collect 100. Okay, let's take a look at a negative one. Negative accounts receivable. Is this amount correct as of 12/31? Yes or no? Same as before. If the amount indicated above is correct, please disregard this confirmation letter. If the amount above is not correct, then explain the discrepancy and then you send it back to us. Okay, so negative confirmations, we only want it back if there's a problem. If there's no problem, don't send it back, throw it in the garbage. So positive confirmation, we get them all back. Negative confirmation, only get them back if there's a problem. Which one of these is the best evidence? The positive or the negative? Which one do you think is better?
Positive.
Yes. The positive is better evidence. And the reason being is you get all of them back. You know, you send out 100 of these, you get back 87. You call up, you know, ask people to send it in. You get back, you know, and now you get back up to 97. And then you got these 3 that you're just going to keep calling, and you know, eventually you end up calling and say, look, okay, you buy a fax machine. Here, fax it over. You know, so the positive ones, you have to collect all of them. So if there's any, you know, that are not collected, you have to get on, you know, get on the phone, get on whatever, and get those turned in. The negative ones, there's a couple problems. First of all, you send these out, and maybe they don't even get delivered to the right address. Maybe you delivered, you know, the address they have is wrong, or it gets lost in the mail. They may never get it. So if they never get it, they're never gonna, you know, even look at it. Not only that, you don't know what happens when they look at it. You know, they pick it up and go, oh, what's it? You know, this is stupid. You know, the guy throws it in the garbage. You know, you don't know that if they're actually, you know, taking it seriously or whatever. So the negative ones, there's a problem with it. And for the negative ones, you really can't make any judgment based on the ones that weren't returned, because you don't know why they weren't returned. May not have gotten them, they may have disregarded them. You know, maybe in the office it got given to somebody that doesn't know what, you know, what they're even asking for, and whatever happened. Okay, so you may say, okay, well, so we should always use the positive ones, right? It's better evidence. Not always. Suppose that you have these 2 options, and option A is to use the positive confirmations. You can send 100 of them out, and the cost is $20 each. Now, option B, you'll be just as happy. However, it's not as good of evidence. So you have to send out a lot more. Send out 500 of it. The cost is $3 each. Which one should you do?
option B because it's cheaper.
Yeah, if you multiply this out, this is what, 20, it's 2,000. And so as auditors, we don't always get the best evidence. Sometimes we get the most efficient evidence. And two, you might say, well, we should always get the best evidence anyways. Well, you gotta remember too, you're spending the client's money. Right? I mean, you're doing the audit and you're billing them based on what what the cost is for you. So even though these negative confirmations are not as good as the positive ones, this is a market. I'll put a little stars by it maybe. So this is what you want to look at because you'll be just as happy, it'll cost less, and eventually, theoretically anyways, that's gonna make it cheaper for the client. Okay, so when is it appropriate? You know those? Yeah, okay. When is a positive confirmation appropriate? And they do tests on CPAs then. Positive confirmations. Testing confirmations are for high value accounts, usually fewer in number. So if you have a high value account, especially for accounts that are, any account that is material, certainly. Use positive confirmations. So if there's a $10 million account, you use the positive confirmation, and usually there's much fewer of those around than the lower value ones. Down here, just the opposite. And usually many in number. So if you have a whole bunch of accounts, usually are a smaller dollar amount, you sell the negative ones. And part of the reason for doing that is that any missed account, or I should say missed error, is probably not material. $10 million account, if it's off, it's probably material. It very well could be material. If it's a $10 account, if it's off, it doesn't really matter too much. And you're gonna send out a whole lot more of these, obviously. Okay. Let's stop here. Let's say be back at 713. And we come back, we're gonna start in on the monetary unit sampling. Okay. Okay, let me see this. Monetary unit sample. Monetary unit sampling is a so not a second. There I am. Monetary unit sampling is a different kind of sampling. It's a sampling method that's used only by auditors. You know, the other sampling that we did, for instance, the classical sampling, if you wanted to take the mean per unit, you could use that for almost anything. You know, you could take the weight of 10 basketballs and come up with okay, what's the average weight of the basketballs, and all that kind of stuff. So you can do that. The classical sampling is kind of universal, and that you can use it for a lot of different things, not just auditing. This one is only used for auditing. This is monetary unit sampling, and because it's only used for auditing, some people have assumed, and actually back when I was going through, they kind of talked about how it was superior to classical sampling. It's actually not. In certain situations, it's better. In certain situations, classical sampling is better. But it is specifically made for auditing, and given the right circumstances, it can greatly reduce the amount of items that you pick for your sample. And that's where a lot of the really expensive testing comes in, is those sample sizes. So if you can get, instead of taking 210 items, if you can get just as comfortable taking 90, well, that's a huge savings, not just for you, but for the client, and saves time and everything else. So it's more efficient. And that's kind of one of the reasons why we do this. There's also some other advantages to it, which we'll talk about a little bit here. Okay. So this is the book value of our sampling. You see, this is the cumulative amount. This is it. It's all adding up. So 500 plus 200 gives you the 700. Add 600 to it. So this is kind of adding it all up. So we have a total book value of 5,000. So all of these add up to 5,000. And these are the book values of them here. Oops. This is what the client gives us. Now, here's the idea behind it. Oops. Go back. Here's the idea behind it, what we're going to do. We are going to take that book value of 5,000 and we're going to break it up into smaller $1,000 chunks. So these are called intervals, by the way. We'll talk about that in a second. So $1,000 intervals, or chunks, whatever you want to call it. And then we're going to choose one item for each in each of these groups. Oops. To represent that entire group. So this one item will represent that entire interval. This one item, that entire interval. You get the idea. So we're breaking it up, kind of like making it into, in this case, 5 different sample groups, but just taking one item and letting it represent that entire part of the book value. Okay, let's see how this works. And basically we're doing it's similar to the ratio estimation. Yeah, you know. I should put similar before, but anyway, you get the idea. All right, let's go back. Okay. So we're going to take 5 items. We'll figure out how we find the sample size. The next page. And so the sampling interval will be 5,000 divided by 5 items. Oops. Okay. Now, what we're going to do next is we're going to pick the item that crosses the interval that goes into the next one. So we're going to look at the cumulative totals, and we're going to look and see which one puts us past 1,000. Then which one puts us past 2,000? Which one puts us past 3,000 and 4,000? So the item that crosses the line is going to be the one that we're going to pick. All right, so looking at these cumulative total here, which item crosses the $1,000 mark? Hold this in.
1,300.
Yep. So this will be our first one that we pick. Let's make it green out loud. Okay, which one passes the 2,000?
Item number 6.
Yep. 3,000.
Number 7.
Yep. And 4,000 is what, 9? Oops, wait, I mean to do that. Try that again. And then last we'll have 10. Wait, is that 5? 1, 2, 3. Yep, okay. All right, so the items we're going to pick are so these are the numbers that we picked. So what we're going to do is kind of like a ratio estimation thing. Here's where I should put them: 3, 6, 7, 9, 10. All right, so let's take a look at this first one. The audit value is 600. The book value is 600. Okay, let's come down there. The interval is 1,000. So 600 divided by 600 is just 1 times 1,000. So the projected value would be 1,000. And the misstatement is 0. There's no problem with this one. So this is the audit amount. And this is the book. Oops. Okay. So we're done with that one. Let's go to number 6. The audit amount is 560. And the book amount is 800. The interval is going to be exactly the same for all these. Actually, I was going to be lazy and put them all in right now. Okay, so 560 divided by 800. Then multiplied by 1,000.
700.
How much is it?
700.
700. Thank you. All right, so this interval we say is worth $700. So what's the misstatement?
100.
See, 300. I'm sorry. The mistake is going to come from the interval.
Oh, I see. Okay, got you.
So yeah, so this would be 300. Yeah, I see what you said that. So this would be 300. So for this interval, we picked this one item, and we said it represents the entire interval, and we're saying that is the entire interval is worth 700. So this is worth 300. Okay, let's go to number 7. 450 and 450. That one's easy. And again, everything is okay on that one, right? 450, 450. $9, 300 and 750. You see, this is kind of just like that ratio thing, you know, audit over book and then multiply it. But instead of multiplying it by the 5,000, we're just doing it for the 1,000, the interval. $400.
400. Yes. The statement by 600.
Yep. Last one is 900 and 900, so that one's okay. Okay. So we looked at this one. All if we add up all the intervals, they all add up to the total book value of 5,000. The projected value is the 4,100. Yeah, this is 900. Okay, so of this total book value, 5,000, we're saying that the real value is 4,100. That's projected value, and the projected misstatement is 900. Okay. Now, what I want to do is go over some of the subtleties of this that make this such a great method for auditors. Notice that we look for the one that crosses the interval. Now, it's more likely that a larger dollar value amount, a larger dollar value item will cross the interval than a smaller one, right? I mean, which one's going to go across that, you know, that 1,000, 2,000, and so on and so forth? Usually they're kind of bigger numbers. You know, they're 600, 800, 450, you know, 900. Larger ones are more likely to be picked. Also, this method picks our sample for us. Oops, that's not me. my scribbles. So this method, it picks our sample. We don't go to a random number table and have to pick this thing. You know, we're not going to, you know, columns 1 and 2 and looking down, trying to match them up with none of that. It picks the sample for us. Okay. Larger ones tend to be picked more often than smaller ones. If the item is large enough, it's 100% sure that it'll be picked. So for instance, if there's an, are these accounts receivable? I can't remember. Yeah, the accounts receivable. So if the accounts receivable is more than 1,000, it is guaranteed that it'll be picked. So if there's an $1,100 accounts receivable, it's going to be picked. If the client cooks the books, the more they cook the books, the more likely it's going to get caught. And if they cook them enough, you know, if they get over that 1,000 interval, it's 100% sure you're going to catch it. So that is really the beauty of this method, is that the more that they, you know, overstate something, the more likely it's going to get caught. And if they overstate it enough, it's 100% sure you're going to catch it. Now, there is a downside to this, unfortunately. This method is good for overstatements. It doesn't do anything for understatements. And notice if they had put an account on the books for $0, there'd be no chance it would get caught. So this method is only for overstatements. And the more they overstate it, the more likely it's going to get caught. And at some point, it becomes 100% sure that it will get caught. But it's not good at understatement. So things that might be understated, things like liabilities and expenses and things like that, this isn't a very good method for. But things that are classically overstated, things like assets, things like revenues, those types of things, it's good for finding. And again, the more that they do it, the more likely it is that it'll be caught. So that's kind of the advantage of it. Oh, projected misstatement, 900. Oops. Okay. We're going to do some finding the sample size. In classical sampling, we did not do the formula for finding sample size. To my knowledge, it's never been tested on the CPA exam. So the most they've had is kind of general questions about if there's more variability, will it increase the sample size or decrease it or something like that. Multiple choice questions. They've never been a problem where they say, come up with the sample size for classical sampling. And there's a reason. It's really a pain. And one of the pains about it is that you have to do you basically have to get a standard deviation before you can pick your sample. So notice the problem there. You basically, you know, oftentimes will have to take a pre-sample of the items to get a standard deviation, especially if it's the first audit that the client's having, to find out how many items you need to take. You have to get a, you know, variation or standard deviation, or whatever you want to put it in there to get that sample size. So it's a lot of work. You know, it can be to get a sample size for a classical sample. Now, it's a little bit of a pain here, but not nearly as bad. We can actually do this in about, let's say 5 minutes or 10 minutes or something. And we don't have to take any pre-sample or anything like that. And basically, here's the formula. Book value times reliability factor, which we'll get to, divided by the tolerable misstatement minus the expected misstatement times the expansion factor. Okay, a lot of stuff here. Let's put in the stuff we know. The book value. I'm going to bold these. Oops. 1600. Oops, okay. Tolerable misstatement. So this is the misstatement that we will allow for whatever this account is. Expected misstatement is 5,000. Okay, now we have to go pick two things here. We have to pick the reliability factor and the expansion factor. So that's what we're going to do for these two. Reliability factor. Okay, so we're talking about reliability factor. Okay, reliability factor. Coming down here, we have our reliability factors. And they tell us to use row 0 or the sample size. Here's row 0. Oops, I forgot something. Risk of incorrect acceptance is 5%. So in other words, we want to be 95% sure. So at 5%, at row 0, this is our factor. Three. So coming up here, I'm going to put 3.0 in there. So that's our reliability factor at 0. We're going to do the same thing down here. Now, the nice thing about the expansion factors is that there's only one row. So, we don't have to worry about getting the right row. There is only one. And the expansion factor is 1.6. All right, so now we're just going to multiply it out. So 1,600,000 times 3. $4,000,008. This is smaller than the other one. Oh, no, wait, wow. All right, so this is 4,800,000. This over here, I would now notice that this is minus. So it's 120,000 minus this. All right, so what's that? 8. So 120,000 minus 8. $112,000. All right. Let's see.
Professor, how did you get 112,000?
Take 120,000 minus these two. So this is minusing.
Okay, thank you.
Yeah, it's kind of wacky formula, but I'll tell you how it kind of works. The more you expect it to be misstated, the bigger the sample is going to be. And at some point, if you expect the misstatement to be too high, you can't use this method because it'll become a negative. For instance, if you expected it to be out by 150,000, you couldn't use this method. All right, I got, let me see here, 42.85, whatever. Uh, 86 maybe. And what we're going to do with that is Um, basically, you round it to the nearest whole one, although I'll tell you about what I'm gonna, so in this case, we round it up to 43 because it's more than halfway. I would tell you though, I would always round it up, even if this was 42.16, I would round it up, just because what are you doing here? You're trying to get evidence. You don't want to go into court and say you rounded it down. It just gives you a little bit more of a margin of error, but the true method is you round it off to the nearest amount, so you can't take 0.86 of an item. So round it off to the nearest whole number, and that is the sample size. So in this case, it'll be that. Book value is 1,600,000. And the sample size is the 43. And so this will give you the interval. I'm gonna round it off to the nearest dollar. 37,209. So that will be our interval. More colors to choose from. I'm gonna take the highlight off here. So this is our, so the first item that crosses 37,209, we're gonna pick that one. The next one that crosses whatever 74,418, whatever it is. We'll take that one, the next one. And any item that's bigger than 37,209 is 100% sure of being picked. So we're gonna take 43 items. And that's gonna be the interval. And yeah. And again, this is way fast. I mean, it's a little clunky right now, but it's way faster than finding the sample size for a classical sim. All right, let's do one more, and then we'll call it a night. All right. Now be careful here. The risk of incorrect acceptance. Your evil teacher changed that to 10. Yeah, and these are multiply. I usually multiply those first and then subtract them out. 1,000. With 9, right? Yeah, this is one. The true method. I'll put the true method up there. That you actually rounded off the nearest one, but I would also say where do I wanna go? But in real life, I think I would probably round it up, just being a little more paranoid. So this would be well, we'll go ahead and use 113. If you use 114, it'll be the sampling interval will be a little bit different, but it'll be close. Ah.
So, Professor, you don't want us to round up to 114?
I probably would. I'll tell you, I'll put it in, I'll put it on both ways.
Okay.
Yeah, because and like I say, for me, I probably would round it up just because again, what are you doing this? You're doing this for evidence and going into court.
Okay.
And we'll run off the nearest dial.
I got the same answer,
Yeah. Okay. Good.
but I didn't round it off to 114 because of 0.23. So I just left it at 113.
Yeah. The true method is you round it to the nearest one. So this is the true way to do it. Just my paranoid auditing self. I would probably round it to 114. If you did 114, it'll be let's see what it was.
I got 21,934 rounding up to 114.
There's something wrong here. Got a crazy number. Okay, so 21,92. Okay, like 930 or something.
Yeah, 21,930 is what I got.
Okay, so if it was 114. And again, this is probably what I would have done on it. 9230. Oops. What do I do here?
Take the 2 out. 21,930.
Here's how I have it done. I've done it completely wrong and okay. Yeah, and then again, like I say, I would probably round it up. But the true method is you round it to the nearest one. And again, this is, so we would pick every time this, 22,124 or 22,930, whichever one you use. So, whatever one across 44, 248, and so on and so forth. You would just keep picking the every item, and anything that was larger than 22,124 or 21,930, anyone that was larger than that would be guaranteed to be picked. So if they are cooking the books and increasing an account, or even if they just increase several accounts, it's more likely that it's going to cross that interval at some point. One of those items is going to cross that interval. So at some point, you're guaranteed to catch it if they're overstating. Again, if they're understating it, this method doesn't do anything for that. Okay. Well, it's probably enough fun for today. Any question on that? And so they have tested picking the sample size for monetary unit. To my knowledge, they haven't done it for classical sampling, but they have done it for monetary unit sampling. Okay. Any questions on that? Okay, I think you guys have a test or something, right? I think some of you've already turned it in. Yeah, okay, so you've already turned it. Yeah, so you're so don't forget the chapter 10 exam is due. If you have Form B, actually let me go back to that. If you have Form B, make sure I sent out an email. There's an error in the original one I sent out in the bank reconciliation. It's off by 20,000. Now, if you already turned it in and it's off by 20,000, don't change it. That's fine. It's an error in the test. But if you haven't turned it in or if you haven't started on it, then the corrected one was sent out in an email. So if you have Form B, the original one has an error in the bank reconciliation. The second one, it's correct. Any questions? All right. Well, have a good evening and a good weekend, and I will see you guys next week.
Okay, Professor. So the Form B, everybody didn't get that. We either had A or B, right?
Yeah, if you have A, there's not a problem with AA.
Oh, okay. All
Yeah,
right.
only Form B.
Okay. All right. Thank you. Bye-bye.
All right.